Hello and welcome to another episode of the Of Interest podcast. My name is Dan Brunskill, and today we're talking to Nick Tuffley, the Chief Economist at ASB Bank, about the Reserve Bank's latest monetary policy review and why Nick changed his own interest rate forecast after seeing some new data last week. Nick, thank you for joining us.
Oh, you're most welcome. Thanks for having me on.
No doubt a busy week for you in the world of monetary policy and economics in general.
Yes, I've been observing the Reserve Bank and was part of it a long time ago, and the releases of the monetary policy decisions always create a flurry of busyness.
How long ago were you at the Reserve Bank?
I started at the Reserve Bank in 1997, so we're sort of talking about over 25 years of either being part of the decision making as a tiny cog or outside trying to look and figure out what they're thinking.
Is that roughly when 2% inflation targeting began in the 90s?
It had been around a little bit earlier than when I started, but it is certainly a 1990s creation, and the definition of the inflation target did start to shift during that time when I was at the Reserve Bank and after. It has evolved, I think, as has our understanding of our ability to keep inflation under control, and also I think some realism over about narrowness of targets versus giving a bit more flexibility as well.
Okay, well, before we get into talking about the recent monetary policy review, let's go back in time a week or two to when you and your team at ASB decided to change your interest rate prediction. You had been picking that the easing cycle would start next year in February, but you brought that forward only to the earlier meeting, but it is a 3-month move because of the summer break. What was it that changed your mind that made you think, rates are going to need to be cut earlier than we had previously thought?
Well, in some ways, we're going back to a view that we had sort of ironically when I look back and we think about even what the Reserve Bank was thinking not too long ago. The strength of some of the recent inflation numbers sort of threw us out, and we started thinking about, they are going to wait until next year now. So we have sort of reversed back to where we were. I think there's a chain of events. Look, first of all, it's increasingly clear that the economy is looking a lot flatter, a lot weaker, certainly, than what the Reserve Bank had been anticipating. We are, in effect, forecasting another mild double dip recession. That may not occur, but it just highlights how weak things look. So there is that coming through. Mark Smith and my team has been devoting quite a bit of time to doing some research on the household sector, and we still see some vulnerabilities coming through in there. Sort of one of them was the labour market, which until sort of late last year was holding up pretty well, and now we're seeing signs of more concerns about job security. Wage growth is slowing, and the number of people in work is starting to flatline as well. So factors like that as well, increasingly having us thinking that the households, having held up pretty resiliently overall, we're starting to crumble a little bit with just the sustained high interest rates. And then the quarterly survey of business opinion results, I think, just the final nail in the coffin that had us just changing the view more formally after focusing a lot on the increasing risks that interest rates would fall a bit sooner.
So prior to that business survey, you were already looking at sort of household pressure and seeing that build, because sort of up till recently the narrative has been, despite high interest rates, households are holding up really well. What do you see that sort of changes that view?
Well, we've still seen the service sector holding up pretty well. So there have been areas of consumer spending where you have seen outright contraction. So look, durables, goods sales in particular are quite weak, but service sectors had been doing pretty well. We're starting to see signs that was faltering as well. The housing market, after starting to pick up last year, so partly through strong population growth, partly through, the Reserve Bank looks like it stopped lifting interest rates. That sort of wore off before the end of last year, and that market's looking like it's going to be pretty quiet this year as well. And that's sort of certainly feeding through to the construction areas as well. But look, you're still seeing the electronic cards transactions generally contracting on quite a sustained basis, and that's despite the fact there's a bit of inflation in there and a lot of population growth still. So increasingly just the signs of cracks coming through in households are becoming more visible.
But you're looking more at sort of weakness in spending and demand rather than sort of what you might call like stress, like credit card stress or that sort of thing?
Well, that sort of financial stress is still relatively isolated. There are some cases, and banks have been reporting it in their results. You can see that the loans sort of past due are increasing, but still at low levels. But it is a sign that stress is out there, and we're still probably working through just that last final number of people who have a very low mortgage rate and are rolling onto a higher one now. So that impact of high interest rates still last bit's working through. And the other thing we're mindful of is that when everything goes back into reverse, this is like sort of an oil tanker going at full speed and then you put it into reverse. You don't see much impact on the momentum for a while, and we're going to have the same problem as that when interest rates come down, that it's going to take time for that effect to come in as well. So also cognizant of that.
Okay, so if you look at the particularly the GDP forecast from before the business survey, the QSBO, it seems like the Reserve Bank, at least, I'm not sure what you had forecast, thought this would kind of be the bottom, and then GDP growth would sort of slowly pick up, going very slowly, but slowly pick up momentum from here on out. It seems like the business survey suggests that's not happening, and actually the next quarter might be flat or down. Do you think that's sort of what people are reacting to and saying, well, we thought there'd be a little tiny gradual recovery from here, but if we're actually continuing to go down in real terms, that could be a big problem for the oil tanker, which might need to turn around faster than we expected?
Well, I think the Reserve Bank has been coming to that realisation. They did make references to sort of weaker activity, and particularly in recent times, sort of high-frequency activity data pointing to a slowdown. The Reserve Bank's forecast had been going, right, okay, it's growth, even if it is weak, but it's positive growth from here. And look, our view is we've probably got 2 quarters where we may see mild contraction. So we do see huge daylight between our quite weak outlook, particularly for the rest of this year, and the Reserve Bank. So look, increasingly, I think part of what's feeding through is activity now starting to show signs that it's buckling again, and in turn that filters through into sort of implications for inflation as well, in the sense that inflation pressures should disappear a bit quicker than what they had previously been anticipating.
How reliable is the quarterly survey? Not sort of reliable, but how closely correlated it is? Because it's what we call sort of tier 2 data. Perhaps the Reserve Bank is a little bit reluctant to react just to that alone. How well correlated is what you see in the survey versus what happens in the real economy later on?
Yes, it's reasonably well correlated, and I think the other thing to bear in mind is that it's got really rich data in it. It's over a range of activity, a range of sectors. So it's not just about how our business is trading. It's looking at how their intentions to invest, what their employment's been like recently, what their future prospects for employment are, a whole range of sort of capacity-related measures as well. So you get a good picture of not just activity, but in particular, how are some of the underlying pressures that they're facing on costs, prices, other constraints showing up. And it does help give quite a good gauge. It's not always going to be 100% accurate. But look, what it's saying now is that look, things like costs and prices look like they're back to a sort of normal level, in the sense that they're not an extreme problem. Labour is really easy to find, and the biggest thing by far and away that's holding businesses back is just trying to get the sales
right
as well. So it is quite useful, and what it is pointing to is that look, through the middle parts of this year, things look like they're going to be pretty soggy on the activity front. And also that we should be seeing signs that underlying inflation pressures are abating at a decent rate.
Because the headline target 2% is an annual figure, we should be living through day to day, month to month, week to week, pretty stable prices right now.
It's a little bit more complicated than just seeing some stability, because one is, I think one thing we've got to remember is we've got a target that's got a wide range. It's 1 through 3%, even if there's the focus on 2%. But within that, look, some prices are quite seasonal as well. So we can't just sort of look at sort of one quarter in isolation and then sort of so multiply that by 4 and say, well, that's kind of where inflation's tracking. Because what we do find is look, you've got council rates at one time of the year, for example. Airfares go up and down at particular times of the year. Food price inflation is quite seasonal, depending on weather. Just there's some examples that are in there.
Yeah, I know. I did try to do some analysis. I can't remember when, sort of a little while ago, where I called up each quarterly data and tried to look up sort of, is it always 0.5 or whatever it needs to be, and it very much wasn't. There'd be one quarter, it'd be 1, and there'd be one where it's 0.1, and I see what you mean about the difficulty of annualizing a quarter or even 2 quarters.
Yeah, so that's why it sort of does pay to look at the trends in particular areas, and also why some of those core measures are very important too, because they give you that sort of overall picture on more the concentration of price increases. So
help me understand then, we haven't had a lot of new data. Even the new data that comes, you can't extrapolate too much from one quarter. What has caused the Reserve Bank to change its tone pretty drastically between May, when they had their monetary policy statement, and this week when they had their review, which seems to me took a much more dovish, a much softer tone? What are they seeing? What are they reacting to?
Well, I think for one, the context is that the May monetary policy statement was a response to the inflation outcome for the first quarter, where it really looked like that domestic component of inflation and the underlying pressures were proving to be a lot more stubborn than they had been bargaining on. And they weren't the only people taken by surprise like that. So that's some context for May. They probably got a lot more concerned about the risk that they're just not getting on top of inflation, hence the talk, consideration of a further interest rate increase. I think when we roll forward to where we are now, it is things like it's just clear that the economy is performing weaker than what they had been anticipating. We are getting signs in the selected price indices, which come out monthly, and also the quarterly survey of business opinion, that suggests that inflation is coming back a bit quicker than what they had been anticipating as well. So it is a case of, I think there's been enough out there to get them sort of thinking hard about, well, actually things have moved on a bit from our assessment in May, and perhaps the assessment in May was overly hawkish. But to be fair to them, it was looking at 2 quarters where actual inflation figures had come out and given a cause for being quite nervous about the time it was taking for inflation to come down. So look, the facts have changed, I think, on the Reserve Bank. So we're seeing that come through. And I think it's appropriate that the move that they are doing, because we do look like we're getting close to that point where, the job is well and truly done.
Okay. I was going to ask you if you felt like it was appropriate, because it feels like a very sharp turnaround, with sort of, it's a monetary policy review, so there are no new forecasts or new research to back it up. It sort of feels like usually they're sort of a bit of a tick box exercise, confirming the policy set at the statement. But then here it comes out and they feel like they're doing something quite different. Do you feel like that's appropriate? It's appropriate time to do it? It's not sort of flip-flopping, as some have complained?
Well, we do. You joke about sort of one time you get like a hawkish message, and then the next time a dovish one. That's perhaps being a bit facetious, but they will react to what they see. And I think a further consideration also is the Reserve Bank has been doing quite a bit of research since late last year on various economic factors and drivers of the inflation process, and what they've got out of that. There'll been some outcomes where they feel probably a bit more confident that they understand the inflation dynamics and have a bit more confidence that they are going to get inflation under control if they see X, Y, Z happen over time.
Do you think when the Reserve Bank comes back in August with a full monetary policy statement, do you think we might see some quite significantly revised forecasts in terms of things like economic growth and the inflation outlook that they may be getting a flavour of already, and which is causing them to change their mind? Do you think we'll see some quite big revisions to the forecast in August?
We should, compared to the May forecast. And something also to bear in mind is that even when the Reserve Bank does these monetary policy reviews, it will have sort of recranked its forecasts again and be working on an updated view. And undoubtedly what that view is showing is that GDP is going to be much weaker over the course of this year than what they had anticipated. labour market probably going to see a bit more unemployment and potentially weaker wage growth coming through than what they had anticipated. And we'll have to see how the Q2 CPI goes, but potentially that also becoming in weaker than what they had anticipated too, and seeing that they've got a view that inflation is getting back to 2% a lot quicker. And with that, I'd expect instead of a OCR outlook that implies that the official cash rate's not coming down until, say, the second half of next year, that it's much, much sooner than that in those forecasts as well. Just reflecting that inflation pressures look like they're getting under control much, much quicker. And that's the key thing that will show that.
You're picking November for the start of the easing cycle. If you are correct, that would mean the Reserve Bank sort of cutting rates 10 months earlier than they had planned. What sort of data do you think they need to see to do that? Do they need dramatically different forecasts, or do you think, and maybe this is a bit provocative, but that idea of holding till August next year was always a bit of a bluff? They were never really going to do it.
In theory, their OCR forecast should be showing their best guess of what they think needs to happen in order to get inflation back into target. Now, quite often you can play this game and markets will be tending to forecast rate cuts tomorrow, whilst the Reserve Bank might be looking at next year. And often you end up meeting a bit in the middle over time. You could argue that some people are a lot more reactive than others. I would expect we'll see the Reserve Bank bring that view forward quite a bit. It does move around over time. It looks a little bit unrealistic that they would hold on that long, to be blunt, when looking at the May forecasts. And it's going to be much more realistic for them to be showing either something late this year or early next year if they were being quite conservative. But I think we'll see substantial movement in their own OCR outlook when we look at those August forecasts.
Is there such thing as a sort of economic tipping point where at some point the feedback loop of falling GDP, consumer spending starts to sort of pick up momentum? And is that the sort of thing we might be at risk of happening now that might cause the Reserve Bank to move not just a little bit faster, but much faster if it senses there's some sort of tipping point? Or is that kind of just a made-up narrative that people in the media like to say?
Look, it's a very real risk. So we've had monetary policy tight for a long time. There's been a lot of resistance, certainly on the price front. But if you get, I guess, want another analogy, just sudden capitulation in that after all this resistance to the pressure, things can change quite quickly. And if you do find, say, the economy slowed quite abruptly, that fed through into inflation falling very sharply, then the Reserve Bank will be looking at, instead of perhaps an orderly, steady cutting cycle, that it has to start responding quite rapidly, in the sense that it's ultimately ended up holding interest rates too high for too long. And that's a hard thing to realise before you get there.
Right.
And often you do end up reacting. And that's happened a few times over history in New Zealand and other places as well. It's certainly a real risk, and I think very much a growing risk. And that is why at the moment, the Reserve Bank sort of, yes, it's risk for regret for a long time has been, if we cut rates too soon, inflation may stop falling back into target or may take off. We're rapidly switching from, they'll be a lot more confident inflation is going to get under control. Their biggest risk now is that they hold rates too high for too long, and you end up damaging the economy, damaging people's sort of employment prospects unnecessarily.
I was speaking to someone who familiar with the bank, and they were talking about the comparison between New Zealand and Australia. We've sort of often looked towards Australia as sort of doing a little bit better than us on inflation, but it almost seems like their inflation is being a little bit more stubborn. There's a possibility they might have to do another hike, whereas we've gone a little bit further. What are you seeing in Australia? Do you think there's like a slight divergence there, where we've maybe gone slightly too far or far enough and inflation is coming down, whereas they've tried to hit the Goldilocks zone and fallen slightly short?
Yeah, it's a bit challenging in the sense that I think for Australia, they have got away with not having to lift interest rates as much. Their inflation pressures, I think, weren't as acute in some sense, particularly things like the impact of wage growth, which was much softer in Australia than what it was here, for example. But the impact on Australians has been pretty marked, in the sense that there's such a prevalence of floating rate mortgages. So the impact was quite hard on Australia, and actually tightened quite rapidly too. So there's a fair bit that's come through in there. We're probably a lot further along in the debate, in that it's really more around when are we getting rate cuts rather than the uncertainty of will we get more. But look, even in February, you'll recall back, there was the speculation we might even see rate cuts here, and the Reserve Bank in May actively talking about it. So I don't think we'll find there's too much difference ultimately in the timing between here and Australia. It does look like, if anything, the timing's shifted in the sense that we may cut earlier than Australia, but there may not be a lot in it.
Okay. Do you have some sort of forecast or idea about where you see interest rates settling after all of this happens? I've seen lots of different numbers floating around, ranging from sort of 2 to 3.5. Do you have a view on, when rates normalise, where will normal be?
Well, we have a view, and I'd say it's more of an assumption, that the cash rate will fall and settle somewhere around 3%. Now, why have we picked that number? At the moment, that is sort of roughly around where we estimate the neutral cash rate will be, when you're sort of looking ahead over time. And by neutral cash rate, we mean, what's the Goldilocks interest rate for the level for the OCR at which it's neither stimulating the economy or holding it back. And that's what we're using as a bit of a guidance for where interest rates will settle. Now, that's the proverbial soft landing, which we never have, I think, in the history of any economy. But around that level is where we see the cash rate sort of gravitating to over the longer term. So that's a fairly substantial cut in interest rates compared to where we are now.
I hear you say the soft landing scenario. If it does play out that the economy has been damped down too much, does that mean the Reserve Bank might need to go down below that neutral, sort of kick it back to life, and then maybe come back up to the neutral once things have stabilised?
That's always a risk, and that's where how the data plays out, particularly inflation, is going to be really important. If inflation just continues to fall steadily back and gravitates to 2% and stays around there, or looks like it will stay around there, then that's kind of your soft landing. If it looks like things have slowed too much and inflation starts plummeting and looks like it's going to be undershooting 2% and who knows where it's going to go, that's the sort of scenario where you almost end up, rather than taking away the restriction that you're putting in place, you're having to not only take that away but suddenly put in place a bit of stimulus as well. And that's it's always a risk. Trying to fine-tune monetary policy where it takes 2 years to fully have your impact on inflation, it's a tough job.
Okay, well, we're looking very far ahead now, so we can park that for our next conversation. It's always interesting having a monetary policy review because it is just a statement. There are no numbers. So I'm going to get you to set your spreadsheets aside and let's do some English literature analysis. I'm going to ask you just what some of the key phrases in the review mean, because it seems like people are reacting to these specific words. So I think the first one that got people excited was members discuss the risk that tight monetary policy is feeding through to domestic demand more strongly than expected. What does that mean to you, and why is it worth the economy reacting to those specific words?
So that's the sense that the Reserve Bank's saying, well, actually, monetary policy is kicking in a lot harder than what we expected, and there's that risk that we do see inflation fall a bit faster than otherwise. So it's essentially saying, look, we may be having more bang for buck than what we bargained for, and we'll get the job done a bit quicker, is the risk that they are considering in there, which just supports that notion that potentially monetary policy is, after appearing to be relatively ineffective or slow to come through, that all of a sudden it is starting to have a decent impact.
What, if anything, can we read into the fact that they only discussed the risk? They didn't agree that it was. Is that significant, or am I splitting hairs?
Well, I think it just shows that, for one, they're not entirely sure exactly if that is what is happening. They've had some initial indications that some of the data suggests things could, in a sense, be slowing up a bit more than what they've been bargaining for. But at the moment, I guess they're viewing that they're not too sure exactly whether that's a direct response to monetary policy or perhaps a bit of noise. So perhaps hedging their bets in the short term, but if we do see activity looking materially weak in what they've been expecting, then they'll be starting to go, yes, actually, we are getting a lot more bite than what we had been anticipating.
Okay. And the next phrase, which is one of my favourite phrases I've ever seen written in monetary policy, they're talking about how rates need to stay restrictive, but then they say the extent of this restraint will be tempered over time, consistent with the expected decline in inflation pressures. What does that mean, Nick?
Well, that's an excellent question. It used to be much simpler in my day. We just used to add somewhat into the phrases when we were writing some of the monetary policy publications. So, look, what I would take that is that they know they'll be easing at some point. It's getting a bit more data dependent in the sense that they are expecting inflation is going to fall. If inflation falls and perhaps faster than what they're expecting, it opens things up for them to sort of cut a little bit faster. I think it's a very fancy way of saying, hey, the length of time we need to keep policy tight, it is kind of coming to an end. It is going to be quite dependent on what we see happening in the data, particularly related to what we're expecting for inflation as well. So it comes back to that notion that, the end of high interest rates is getting near. We're not getting this sort of commitment, or reference to it sort of being here for a sustained period anymore. But as always with monetary policy, everything's data dependent, including exactly that timing of cuts and the pace. If you're a central banker, you really like to make sure you're keeping all your options open.
Right. I also, some people pointed out that it was interesting that it said expected decline in inflation pressures rather than a decline in actual headline inflation. Does that mean they might be looking ahead a little more and willing to say, well, our forecasts look good, so we're happy to...
If they're looking ahead and they go, well, actually, look, the pace at which inflation is coming down is a bit more rapid than what we're expecting, we probably need to be cutting a little bit earlier. So that's in a sense what they're looking at, is for a gauge of, is their inflation outlook going to be shifting? Are they looking ahead going, well, actually, we should be revising down our inflation outlook? And if they're doing that, then they would be probably a bit more confident they can cut sooner, in a sense. I think we're going to spend the next 6 weeks desperately all trying to analyse exactly what they mean by that phrase.
I found myself repeating it in my head. The extent of this restraint will be tempered over time. It's really musical.
Yes, I think if there's one thing with economists and central banks in particular, if you can come up with 10 very sort of multisyllabic words to say something when you could have just used sort of 2 words, you've done a good job.
Okay. Well, I guess to wrap up, Nick, what are you going to be looking at between now and August? What are the key data points? What do they need to show? And what, if anything, would cause you to change your forecast again?
So look, between now and August, there's some pretty key events. So one is the CPI that's coming up for the second quarter. So seeing how fast the sort of various core inflation measures are coming down, how quickly service sector inflation is coming down in particular, and also to some extent the non-tradables, that speed of descent is going to be pretty key. When we look back at the Q1 CPI that sort of set off the Reserve Bank for May, look, it was just the stubbornness of some of those measures that's what really sort of spooked them a bit then. So that's going to be really critical. Inflation expectations as well. So that's how we are responding to what we see and influencing our price and wage setting behaviour. So that's important. We've got labour market data coming out as well. And again, the pace at which unemployment's lifting, the pace at which wage growth is slowing, factors like that are going to be pretty key. Looking ahead longer term, we've got the quarterly survey of business opinion coming out in October. That comes out ahead of the October meeting. That'll be pretty key too, particularly for the thinking of that meeting. The following CPI for Q3 isn't out until after the October meeting, but that will be pivotal for the November meeting if we haven't seen the Reserve Bank move interest rates already.
And you think it's likely we'll see that headline inflation print below 3% in that third quarter?
Yes, we do. And our expectation is that the second quarter will already be down somewhere around about 3.4%. So the more daylight you see between where the CPI is and the top of the target band, in the sense that we've got under the 3%, the better as well. And the Reserve Bank it's got that growing confidence that inflation is going to be looking pretty low next year. And building that confidence is really key for the Reserve Bank's assessment of now is the time to cut.
Brilliant. Nick, I appreciate your time, appreciate your thoughts. Thanks for joining us.
Thank you very much for having me on.